Welcome to Market News You Can Use. I'm Dustin Laporte, your host, and today we're going to talk about some things that you absolutely need to know. And I've gone through hours and hours of research and just narrowed it down to right to the point, right to exactly what you need to know, and give you strategies and ideas to make better financial decisions, especially in this current market storm that we're going through. Now, the storm we've entered into so far is acting like a normal bear market situation. You see it come down, you've seen it gradually come down over, and it hasn't been an avalanche, but we've seen it come down to got right below 24%, and then it bounced back up. When I say market, I'm talking about the S&P 500's top 500 largest stocks help represent about 80% of what's going on out there in the market. And so a lot of you have been calling in and asking, have we reached the bottom? When do we know the bottom is? Well, we don't know for sure, but what we can do is look back at history. And so I'm going to share my screen here. Let's take a look. Let's go to my website, the market update, and here's a resource. And when you click onto it, it comes up with this report right here that shows you that on average, a bear market usually drops around 30%. But if it's a recession involved, it's usually down around 35. And if there is no recession, then it drops around 24 and then bounces back up. So where are we? Are we this situation? Down 24, we've already hit it. So in theory, we should be bouncing up. In fact, there's some indications that it's possible that we could be starting to bounce back up. But if we're headed to a recession, you should expect it drops another 11 or so percent on average. And so how long do recessions and bear markets last? Let's click on to that link. Love this by Capital Group, shows that recessions usually only last about 11 months. And you can see these little dark purple areas. That's when the recessions have been since 1950. And see all the blue, that's the increasing economy. That's the expansion. And how's it impact the market? Well, as you would expect, recessions cause the market to pull back, and it usually drops on this report around 33 instead of 35, but give or take there. And it typically only lasts 14 months until it takes off again. See that? See all the deep purples? And see the blues, or it's taken off. So 72 months usually of expansion, 14 months of contraction. But the comebacks are they're always greater than the setbacks over the long haul. And let's dive into that information some more. And before we go there, I want to talk about midterm elections. How does it impact the market? Well, it's unsure. It's unsure which way, who's going to get in office, who's going to take over, how are they going to change the are they going to be good for the market? Are they going to be bad? And so this uncertainty causes the market naturally to draw back about 16% anyways. But what fascinates me is this: what happens once the fallback has happened, the lowest point? From the lowest point to 1 year later, what's the average return? 37%. And if you weren't in it, then you couldn't win it. You couldn't receive the comeback that helped offset the fallback. Page 14 on the guides on how to talk to your clients about market declines. Love this part. It's an older brochure, but it's still a goodie because it shows a similar type of concept, is that every 15% decline in the market, it's recorded right here, and the average increase after the fall 12 months later is a 55% increase. That's, as you can see, the comebacks are usually greater than the fallbacks. So very important piece of information to know and how to handle this market. Challenges, I've had a lot of you want to get out of the market and say, well, we'll get back in when it's right to get back in. The problem is you might miss out on some of the best gains in the market. And it's amazing. This is a great piece that just came out on July the 29th by Dimensional Funds. And it shows the Russell 3000, which is 3,000 stocks instead of 500 stocks, which is even a greater representation of the overall market. If you put 1,000 into the Russell 3000 25 years ago, you would have seen that 1,000 grow to $10,367. But if you just missed 1 week on November the 28th, the week ending of November 28, 2008, it's right in the heart of that, the Great Recession. This is the return that you would receive. So you're in the stock market the whole time except for that 1 week. That's how much missing 1 week impacted your future growth. Miss 1 month. This is during COVID. Instead of 10,000 something, it was 8,000 something. Missed 3 months during that COVID time period again too. You had only had 7,300 versus 10,000. Missed 6 months during the Great Recession, and this is what your return would be. So it's so dangerous to just even get out for just a short period of time. And this one I'm getting ready to show you, this is put out, it's called Understanding Market Volatility. I don't like it as much as the other one, but it's still a good point because most people aren't just out for 1 day. But if you just missed just 1 day or 10 days, excuse me, this is a S&P 500, just a 10-year period of time. So 10 times 364 days, so 3,600 something days. If you just missed 10 of those 3,600 something days, your return would be significantly cut. If you just miss 20 of the best days, your return's cut in half. You miss 40 of the best days and you're pretty much break even. So it took 40 out of 3,640 something days. Just 40 of those days, if you took them out, the 40 best days, you wouldn't have made anything. So, so when do you get in, when do you get out? Extremely difficult to know. And this is extremely important to know too. Everything's this stuff. Like I said, I try to pick the best of the best. Invest $1,000 in the S&P 500 from 1992 to 2021. Your range of returns would have been from anywhere from a negative 37 to positive 38. That's the annual returns. And the returns actually, you had dropped even more, over 50 something percent, but this is just showing from annual to annual return. But over that 30-year period of time, if you did nothing, it would have grown to almost 21,000. That was $1,000 investment during that time period. But what people don't talk about, they talk about, oh, your 1,000 grows to almost 21, but they don't talk about, well, you had to deal with ups and downs around 37 down and 38 up. That whole range went on annually. So some years were up more than others. And let's go back to this market update. This part right here is loaded with information. It's called JP Morgan's Guide to the Markets. And we're just going to sample just a couple of pages. You see it listed on here because I think those pages are vital to what you need to know. And it's 70 something pages. And so, but we're not going to go all of them, but just some highlights here. So if you look at the last 20 years, price per earnings, and you look at the average price per earnings called PE ratio to where things are currently, what you'll see if it says like this is 103.5% in the large cap blend, that space, which is the S&P 500 space, it's basically right. If it said 100%, it would be exactly where it's been as the average 20 years. But as you can see, these are below the 100%. And when it's below the 100%, it shows some areas of where the market is underpriced. The only area that I would not fully trust is this area right here where it says small cap growth, because some of the small cap companies, especially in the small cap growth area, I think the one report I read almost 50% of all small cap growth stocks they don't have earnings, so you can't even calculate PE ratios. So this could be off some. So I'm not fully trusting that. Small cap value, the ones that I've been looking at, show reports on factor in the companies that aren't earning, but most of them are. And so, but the point being is this area right here, which is the huge part of the market, is underpriced based on historical 20-year P average. And Morningstar, which if you Google almost any mutual fund, you're going to see a Morningstar information. They're the top research firm out there for mutual funds. They also pick stocks, and the stocks that they cover, they said almost all of them are under their fair market value. So that means, in which they put, there's a lot of opportunity out there. So let's move on a little bit longer here. This is so cool, because I hear people when the market dropped 14%, I had to remind people that 14% drop is what happens almost every year. That's the average for the last 42 years. But even though the market usually drops 14%, 32 out of the last 42 years, the market ended up the year up. And I love this because you can see, like when COVID hit, the market dropped 34, but ended up the year positive 16. This year, let's pick another one. Market dropped 49%, but ended up the year positive, not positive. I wish it was that year. That was during the Great Recession. It was still negative 38. But the point being is it at one point dropped 49% and recovered by the end of the year up 10%, but still was down from where it's fallen for. But, there are many times, like right here, the market dropped 30% and it ended up the year negative 13, dropped 34, ended up negative 23. So there are times in history where the market pulls back even during the year substantially, and then can still, like right here, negative 34, but ended up the year positive 2%. So just because we're down doesn't mean that we still cannot end the year with a positive note. Let's go to number 25 on here. 25 shows us, if you look at the history of following consumer confidence, it's called the Consumer Sentiment Index. Anytime sentiment is really, really low and it falls below this mark right here, that's usually a mark that we've hit the bottom and the market turns around. You see right here, hits the bottom, turns around. But right now we are at a historic low. It hasn't been this low for 50 years. So that's a good sign that, when fear is at its greatest peak, that's usually when the market finally bottoms out. And those who are fearful have already gotten out, and those who have courage get in, and they start pushing the market back up. So let's go to 32 on the slides here. Oh, by the way, oil production, we were in 2020 one of the largest producers of oil in the world, and we produced more oil than we consumed, and we're on projected path in 2023 to be back to producing more oil than we consume. So that's a good sign that can help drive oil prices down. And all of us have seen the impact that oil prices have made on us. So, because, gas prices goes up, then almost every any part that deals with shipping costs goes up, and that gets passed on to us. So point being, as far as the fixed income market, you can see negative on all the areas there. There's not been much that you can run from on that. And you might have said, well, what if I had been international? Negative. So once again, not too many places that you could run to for protection. Cash was pretty much the major area that you could find protection in, but even in the global equity markets, United States and different major markets overseas, all down, all down. So what do you do when the market's down like this? What are your next steps? What are some of the most prudent decisions that you can make during this time period? And I want to go over that and want to show you what you should do, what things to think about. And I'm going to change my screen on here. These are my notes. And I would say the recap would just remember the stock market usually drops many months before a recession. And it's before the officially announced that we're out of recession, the market had already climbed out of it. So it starts dropping many months before the recession and starts climbing many months before the recession is over. And recessions usually only last for about 11 months. So what can investors do to be prepared? Well, first of all, stay calm, keep a long-term perspective, and refuse to panic. Follow a proven plan. Stay invested. Meet with me if you need some encouragement. And as far as strategies go, I want to stop sharing the screen here. As far as strategies go, this has got to be one of the best times to really reevaluate what you're investing in, what your plan is. For example, if you have an old index annuity or an old fixed annuity, and it's out of surrender, typically happens when they're out of surrender. There's no commitment. You can walk away anytime, and so they do not give you as high an interest rate that you can get elsewhere. And there are, as of this moment in time, if you had 80,000 or more, you can actually transfer that money over into a 5-year 4.1% interest rate. There are products out there that are paying over 4%. That's a very significant safe rate of return. Another fixed index annuity, not index, but a fixed annuity. So it's not even tied to the index. And there are other index annuities out there that may pay a higher participation rate or just be better suited for you. If you have bonds in a taxable account, this may be a great time to sell some of them to lock in those losses, but turn around and buy not substantially similar, but like you could buy into that annuity paying 4 point something versus being stuck with a bond that could actually lose value if interest rates keep on climbing, as you've seen. So that's a strategy, or go to safer investments. There are, as of right now, treasuries that are paying around 3%, and CDs that are paying around 3% that are low short-term commitment. So there's some strategies that we can do there. As far as your equity positions, we may want to lower our volatility by using some hedge fund strategies that are out there, or maybe look at some, for your income needs, some protected income strategies, or look at, strangely enough, option writing strategies that mutual funds have. So there are all different techniques that you can do. And especially if you have a traditional IRA, the Trump tax cut is set to expire soon, and unless they get enough votes to change it, and if it does expire, then you may be in a higher tax bracket in the future than you are right now. And so it may make sense, if you're in a like a 12% tax bracket, it may make sense to convert some of your traditional IRAs into Roths, pay the tax now, and so that you'll avoid the tax in the future. And if you had 100,000 and it drops 20% in value and it's now 80, and you convert that 80, and then it turns around and grows back up to the 100, that 20,000 in growth in the Roth is tax free. So that's why it makes sense to convert the Roths now. Don't wait when you get closer to retirement. If you already know what tax bracket you're in and you know what the upper level it is, then we'll work with your tax advisor and we'll figure out how much we need to convert now. So these are ideas that and strategies that are valuable, and you need to know about them. And if you need more information, that's what I'm here for. So that concludes my market update of news you can use. Talk to you soon.